some of the mid cap and smaller cap companies are kind of in limbo here, and they need to do something. And so I think they'll be, because they're becoming less important to the indices and to the generalist investors, they need to do something to fill their portfolio to make their stocks a little more interesting.
This is an environment that brings both buyers and sellers to the table.
If I were in this industry and I had, I was a CEO and I had a company with access to capital, yeah, I'd see lots of things to buy.
My gosh, in December, to load up on these juniors is going to be, I won't say a no-brainer, but it's going to be very compelling.
I've got a stellar group of fund managers here with me today, all leading successful precious metals portfolios. And we're going to be hearing from everyone's different sort of approaches and views on the market at the moment. So introducing everyone, I have Lawrence Leopard, partner at Equity Management Associates. I have Peter Miletus, who's Vice President of Merck Investments and also President of ASA Gold and Precious Metals Fund. Matt Geiger, Managing Partner at MJG Capital. I also have Adrian Day with me, whose video doesn't seem to be working at the moment. But Adrian's got a slightly patchy connection as far as I know. But hopefully we can get him logged in successfully throughout. In the interest of time, we'll keep going, and I might chat with Adrian on the sides about sorting out his connection. So, gentlemen, thanks very much for joining. I wanted to start with, where are we in the gold cycle? What seems to have slowed the bull market perhaps this year? Surely the backdrop, the macroeconomic backdrop, is very healthy and very constructive for precious metals in general. But why might we not have seen capital flows rushing back into gold, precious metals, and the equities that we might have expected? Larry, could I start with you and get your take?
Sure, quickly. I think it's a combination of factors that have made gold correct. I mean, one, it went a long way very quickly for 2 years. It was up 50% in the course of 2 years to the peak in August. And all markets breathe, it's down 15% now, not a terribly deep correction. The stocks are a different matter. That's, I think, driven by the fact that the Fed tried to portray all the obvious inflation as transitory, and it's not. That's becoming obvious to more people now. But until it's completely obvious, surveys said 70% of the people believe the Fed that inflation was just a COVID thing, it would go away quickly. We don't have a long-term inflation problem. So that reduces the need to have precious metals. And then I think, just general sentiment, it got too heated last August. And of course, this is a very volatile market. When people get concerned about it, they run the other way. But I think it'll be changing fairly soon. I think we'll be on to all-time highs within 3 to 6 months.
Really, yes. So gold price sort of topping back over $2,000 quite soon, then, you think?
Yeah, I do. I really do. I mean, it's inflation is very persistent, obvious. And as more and more people become aware that we've left the deflationary period that we were in for 40 years, inflation is the new theme. They're going to seek inflation hedges, and gold is the best. So,
yeah, okay, interesting. Peter, could I turn to you and get your take of where?
Yeah, I don't have a lot to add to what Larry said. I mean, at the end of the day, I agree with most of it. I think that the typical playbook is the Fed's going to have to raise. People expect that the Fed's going to have to raise rates in the future, and so they're anticipating that move. I don't think, even if they attempt to raise rates, I think that's going to be short-lived, and I don't think the economy can really handle it. So I'm still, more than cautiously optimistic that gold is in a still pretty strong place, and we just saw kind of the typical third quarter sort of weakness in terms of liquidity, and you saw it on the one day that gold dropped almost $100, and on a Sunday night, our time sort of moved, which is kind of an odd thing to do, but the market overreacted to that point, and we've kind of been stabilized here. Where I think we're building a base technically, and I think things fundamentally look pretty good.
Yeah, and I don't want to call out a price prediction if that's not something you want to do in a public forum, but are you expecting gold to go higher off the back?
I don't. The idea of predicting a specific price in gold is probably way outside my skill set. I have guys that work with that are better suited to that, but I'm bullish on gold, and I'm investing as such that gold's going higher, and the equities at some point will follow on.
Yeah, fair enough. And maybe it's worth adding that this is a constructive price, regardless of whether it's going higher or not. It's a good price for companies to be making money, right?
Correct. Yes. I mean, operationally, the producers are in as good a position as they've been historically.
Yeah. Okay, Matt, let me bring you in. Anything to add, or to sort of to shine on what's been said already, and do you have the same sort of bullish view on where the gold price might be headed?
Mm-hmm. Well, on the prediction front, I mean, my style of investing is to assume spot prices persist for the foreseeable future. So when we're looking and evaluating gold equities, my assumption is that we're going to see $1,700 gold for the next 5 years. And I want to pick equities and back teams and back specific projects where I think there's value that can be added in that environment. I think there's a good chance that I'm wrong. And if that's the case, then great. If gold does rise up to $2,500 in 3 to 6 months, as Larry said, or it takes a little bit longer than that, then anybody with exposure, even to more of the higher quality projects, less of the optionality plays, will do just fine. In terms of where we are in the cycle, I mean, there's no question that we're 14 months deep into what I would say a bull market correction. Folks that bought their first precious metals in summer of last year, or maybe re-entered the space after a decade of steering clear, they're obviously in a world of hurt, and I can sympathize with them. But for those of us on this call that have been invested in precious metals since 2016 or even before then, I agree this is quite a constructive price, and we've seen a lot worse periods in the past decade than what we're at right now. I mean, I think the reason for this pullback is relatively simple. I mean, we're firmly in a risk-on environment at the moment, and that's been driven by these large-scale, fiscal and monetary interventions that we've seen in the aftermath of the COVID panic of last year. And I've had plenty of generalist friends reach out to me and ask what's going on with my PM exposure. Is it time to bail? And my question to them is, well, what's happening with the rest of your portfolio? And they come back to me and say, oh, well, the second house that I bought, or the house that I bought, is up 30% since I purchased it last year. The tech stocks that I've owned for the past 10 years continue to rip. My small crypto exposure is now, getting close to the spring 2021 highs. The NFTs that I'm dabbling in are, rising exponentially in price. The uranium juniors I'm speculating in, even after the recent pullback, are doing quite well. And then I say, well, that's your answer right there. I mean, if the reason that we're invested in precious metals to begin with is not to outperform these more speculative asset classes in the midst of a hardcore risk-on environment. If you think that we're going to be risk-on here for the next 5 years, and it's going to be gravy, and stock markets are going to continue to rise to all-time highs, then you probably shouldn't be in the precious metal space. But I think those of us tuned into this call probably have a more realistic view of where things are going. And when you see irrational exuberance, going on for well over a year, it's likely that you're going to see the flip side of the coin as well at some point. So, I would urge folks to think of the reasons why they have precious metal exposure to begin with, and show some patience, and understand that in these types of market environments, whether you agree or not that this should be a risk-on environment, the fact is it is. You shouldn't be expecting gold to be outperforming the rest of your portfolio. That can change in very short order, as we saw last year in the spring.
Yep, certainly. You touched on some great things there, Matt. I'm just going to ask Adrian to come in for this introductory round before we can delve into some of those points that you raised in a bit more detail. Adrian, what's your take on the sort of risk-on environment? Do you have anything further to add? Oh, I'm not sure his feed is coming through. Okay. Adrian's going to try and log back in. I've just got a message from him. When he joins us again, we'll resume back. Okay, but let's come into some of the sort of portfolio strategies that you gentlemen are applying now. And how should investors that are tuned into this call, for instance, think about exposure to gold mining equities? How have the miners performed, and where might the value be within the breadth of the gold and precious metals mining tier. We're constantly talking about quality assets, quality mining teams. Is it as simple as saying that the juniors are where the value is going to be right now? The producers who sort of are sitting in a slightly trickier position, trying to look out for growth.
Adam, let me take that one or start with that one. I mean, if you look at the mining equities, there are really three buckets. There's the producers, the developers, the drill stories.
Yeah.
And at any given point in time, one of those or two of those will look better or worse than the others. A couple of years ago, the drill stories looked the best. You could actually buy deposits at pennies on the dollar. They've all run pretty hard, and I'm finding a hard time making new bets on drill stories.
Right.
The developers are interesting, special situations, and some of them look really good. But the issue they're all facing is they're going to have capex increases, as we've already seen at IAMGOLD and others. And so, they may have an old, feasibility study that says they can build a mine very economically, but if their capex is going to go up a lot, the numbers are going to change. To me, the real deep value and the exciting part where I'm adding to my portfolio are the producers. And obviously, I'm looking for ones that are growing production and ones that have a lot of operating leverage to the gold price, because I think the gold price is going up. But I find it rather stunning that you can find big, well-managed, professional companies, not small, risky stuff that trade at 2 or 3 times EBITDA. And I've got a bunch of those in my portfolio, and to me, it's one of the sweetest opportunities I've seen in this space in many years.
So you think they're quite undervalued at the moment? But,
I do. Some of them, not all of them. I mean, look, they're all cheap relative to the metal and relative to where I think they will be and should be.
Yeah.
But some of them are extraordinarily cheap.
Yeah.
I'm just extraordinarily so.
Is there something to be said around the idea of replacing mine ounces and the challenge of growth? Do you as a shareholder of a producer, do you want them to look for M&A or growth, organic growth, or do you want them to keep returning cash and dividends to shareholders? After this long period of cost discipline, is there a resistance for producers to add growth and then improve their valuation that way?
Let one of the other guys take it.
Yeah.
So I mean, I can add to that. I mean, I don't disagree with Larry that the producers are extraordinarily cheap, and on a price to NAV basis they are very low. My one issue is that a lot of on the large side is I think they're just effectively proxies for the gold price. You need the gold price to go up. I think one of these balance sheets and the cash flow generation that these guys are doing is stunning, and there's like I said, is the best position they've ever been. But that being said, an odd sort of way, they're losing their leverage to the gold price because their balance sheets are becoming a bit lazy, and it's not for their own fault. I mean, it's just that we're in such this gold price, things look great. So I think if you think gold's going up, yes, I think the gold producers are going to do quite well. I think you can get better leverage when you move down the productions, to the mid and small cap producers. But I also still think that if you go to some of the junior or the exploration plays, if they're catalyst driven stocks, you can get outperformance if they have news flow. And again, that's a lot of key. I inherited a top heavy portfolio about 2 years ago, and I moved into the smaller names. And then we funded a lot of these companies to do their drill programs and then development programs. And as it takes time for that money to flow through the system, where they get the money, they produce, they put a plan together, and they start putting it together. And assays have been, taking a long time to come out. You're starting to see the news flow where these stocks are starting to outperform on a relative basis. Some of the small, but I agree with Larry, like some of these mid cap, small cap producers, with the growth, I think it's important to say that there needs to be some growth there. Do have a chance to be really good performers.
Yeah, excellent. Adrian, I see your video's back on now. Can I bring you in here and get some commentary on what we've been covering? We've moved on to sort of portfolio strategies now, and where you see value in the different tiers of miners, gold in particular.
Yeah, well, obviously, I apologize, first of all, but I also missed, obviously, what some people said. So I'll just summarize my thinking. I certainly agree with what I think Lawrence was saying, which is that the senior stocks right now are just ridiculously cheap. And you can look at the XAU, or you can look at specific names, and you see that they're trading in the lowest, on many metrics, they're trading at the lowest 10 percentile of their historic valuations, which really doesn't make sense when you look where the gold price is today, when you look at the cash flow generation. Now, maybe the market is thinking ahead. We'll maybe get to that later. That's a different issue. But they just are ridiculously cheap, and they're in good shape, as was said. Now, obviously, again, I think Peter was saying that when you're in good shape, it reduces some of the leverage that you have. But one of the reasons that I like the seniors right now is because they are the most certain to move. If gold goes from 1750 to 2000, there is very, very little doubt that Agnico and Newmont and Barrick and Goldfields will move. But if I buy Ajax Exploration, I could easily find that the gold price goes up and I don't. Now, having said that, and I would have, 3 months ago, 2 months ago, even maybe 1 month ago, I would have left my answer there. But frankly, right now, some of these exploration stocks are just getting beat up so badly. They are just so ludicrously cheap. I think a lot of them are going to get even cheaper before the end of the year because of tax loss selling. I mean, Matt, I think, was talking about Bitcoin and houses and, the S&P and everything else. People don't have a heck of a lot of tax losses this year. Even oil stocks don't give you a tax loss this year. The only place to get your tax losses is in gold stocks. So I think we're going to see a lot more tax loss selling towards the end of the year. But I mean, my gosh, in December to load up on these juniors is going to be, I won't say a no-brainer, but it's going to be very compelling.
Yeah. Okay. Within that, Adrian, how are you filtering the juniors? Obviously, this is simple stuff that we've sort of talked about many times, but I've had a lot of questions from the audience in advance of, the team or the asset, and, ideally both. But what are your top criteria for selecting from these juniors that are going to?
For me, it's easy. It's management the whole time. I'm not a geologist. So, or a technical person at all, a mining engineer or anything. So when I'm looking at an exploration play, if I look at the geology of a particular project, I have no edge over anyone else, not just the experts on the panel, but the broad mass of investors. I don't have a big edge. But I think I'm good at looking at teams. I'm good at looking at balance sheets. And I would say that I would always prefer a top manager, a top CEO with a good team and a strong balance sheet, but a lousy project, because they'll go out and find a good project. And I prefer that over a great project with a terrible team and no money.
Yeah, indeed. Okay, Matt, where's your focus for value at the moment within the tiers of gold mining companies?
Right. Well, I think I'm a bit unique on this call in terms of the niches of the market I'm poking around with. I don't disagree with the points about the senior producers or the mid-tier producers, and there may be an opportunity that I'm missing there. But really since the MJG fund's inception, we've been allergic in a large part to producing miners across the board. And at the moment, we only have one producing miner in the portfolio, and it's a nickel miner based down in Australia. So we have no producing gold names in the portfolio. All of our cash flowing names come from the royalty business model. So we're pretty well weighted towards the royalty model. We're about 35% weighting at the moment within the MJG portfolio. So that's where I go for the cash flow. If we do see $3,000 gold next year, I do admit I'm not going to see the leverage that we would see with Larry's portfolio, for instance. But that's where I go for the cash flowing names. In terms of the development stage names, I do want to draw a distinction. I think it's important. I don't think you want to throw all development stage projects into one bucket. There's really the high quality projects that make sense at $1,700 gold, maybe $1,500 gold, maybe $1,400 gold. And I think if you're in the development space, those are the projects that you want to focus on. As I mentioned, I'm assuming $1,700 gold here for the foreseeable future, and so I'm not a fan of the quote unquote optionality plays. Large, low grade, high capex, low margin deposits that make no sense at current gold prices, but could light up a spreadsheet at $3,000 gold. That's just not my style. But for folks that do have that ability to time the market, there is potentially opportunity there. But I focus on the development stage on the higher quality names, and the hope there is that these names will be bought out by some of the producing names that perhaps Larry or Peter or Adrian hold in their portfolio. And to echo Adrian's point about the exploration space, I'm doing a real deep dive here over the past few months into the prospect generators. And that is a business model that is incredibly out of favor. It's been out of favor here for at least 15 years, maybe longer. But I think, and there's only about 40 odd prospect generators out there across North America, Australia, et cetera. I think if I'm evaluating them through multiple metrics, but as Adrian says, it always starts with the people. Are they properly incentivized? Are they honest? Do they have discoveries to their name already? Have they treated me well in the past, or have they treated investors that I respect well in the past? Looking at that from the people perspective, then looking at it from a downside perspective. Adrian mentioned the risk of tax loss selling in these coming months. I think that's a very real concern. One way that you can quantify potential downside is to look at the company's market capitalization relative to their cash and marketable securities position. It's kind of a sense of, in a worst case scenario, shit hits the fan, how far can the share price fall before they're trading, at their liquidation value? And there are some PGs out there that have a very large percentage, if not all of their market cap covered by cash and marketable securities. So those kind of situations get me excited. And then, I'll also look at the dilutionary risk. The whole point of the prospect generation model is to avoid dilution. And I think that's one of the key strengths of that business model. And some of these companies do it very well and could go years and years, if not a decade plus, without raising. While other of the prospect generators haven't done as good of a job of avoiding dilution, and you should steer clear. And then finally, I'm looking kind of from a bang for your buck perspective, comparing the expected partner expenditures. So these bigger parties that are coming in and earning on the projects relative to the company's enterprise value. And that gives you a good sense for how much partner expenditures you're getting per every dollar of valuation. So I've been going deep into that space. We've recently added a new prospect generator to the portfolio. I admit that this is a space where very few folks are poking around at the moment, but from my contrarian mindset, that actually gets me excited.
Yeah. Excellent. You touched before we were talking project generator on other plays and how you were expecting or hoping the portfolio companies might be taken out by a larger producer, and that leads me on to M&A. Particularly wanted to ask, do you feel that we're on the cusp of significant M&A, particularly as we're coming out of sort of COVID, travel restrictions, things like that? Due diligence can be completed. Are we on the cusp of big M&A in the mid-cap developer space?
Right. Well, I can touch on that quickly. I mean, I would say we're in the midst of a flurry of M&A activity at the moment. I expect that to continue. I mean, I have been saying for months and months here that once travel restrictions ease up and we start having the ability for technical teams to go and visit specific projects, we are going to see M&A pick up. We're also seeing the conference circuit start to gain steam again. With the recent Beaver Creek and Denver Gold Show conferences, and I know there's a lot of deal making happening there behind the scenes. So the travel perspective is big. You also have the fact that this is an environment that brings both buyers and sellers to the table. If you look back to last summer where precious metal prices were going vertical and the prices of equities were as well, neither of those groups wanted to come to the table. The potential sellers didn't want to sell out too early and shortchange their shareholders, and the buyers didn't want to make a foolish acquisition, which if you were acquiring in Q2 or Q3 of last year, you probably feel pretty foolish, 14 months hence here. So this is an opportunity in this consolidation period for parties to come to the table and come to agreements. And then finally, just because of the passive, the ETF focused investment environment that we're in and have been for some time, there is tremendous value, at least in the short term, for consolidation. Just the simple fact you're increasing your market capitalization. There has to be a rebalancing within these ETFs, and then you see non-fundamental buying on the back of M&A. So from my perspective, that's not a reason to do M&A. That's more of a short-term boost. And I think it takes years to actually determine whether a particular acquisition was a good decision or not from an acquirer perspective. But at least in the short term, you do get that short-term boost of either increasing your weighting within the GDX or GDXJ, or in some cases, making an acquisition, getting over that market cap threshold and getting into these ETFs for the first time. And you can see a large amount of non-fundamental buying in short order.
Yep. All right. Okay. Has anyone else got thoughts on the M&A?
Sure. Yeah, I do. I mean, obviously, historically, I've and continue to believe that most of the mid and large cap companies are coming up on a production drop and reserve drop. And, we did see the transaction between Agnico and Kirkland Lake. That is not a resource kind of generation type acquisition. It's more for the generalist investor. There's a lot of companies in this middle range that are kind of orphaned in some ways. And so by moving up into the large cap names, so closer to Newmont and Barrick, that transaction makes sense. I don't think it really benefits my portfolio that much. But what I do believe is that there's some of the mid cap and smaller cap companies are kind of in limbo here, and they need to do something. And so I think they'll be, because they're becoming less important to the indices and to the generalist investors, they need to do something to fill their portfolio to make their stocks a little more interesting and backfill production the gap. So I do believe that we're getting close to a point where these guys will start taking out some of the development companies and some of the exploration stuff to fill in the gap.
Right. Yep. Larry, is that something you're in agreement?
Yeah, I mean, I think there will be M&A in the space. I mean, it's funny. There should be a lot of M&A in the space, a lot of value right now. If I had currency and access to capital, I know exactly what I'd buy. And yet, managements in this area don't tend to be the brightest bulbs in a lot of cases. And so they'll wait until it's a lot more expensive and they'll buy it then. At least that's been my experience.
Do you think that shareholders are cautious though around, releasing the shackles and letting management do that after what happened in previous cycles?
Well, I don't know. Yeah, I mean, obviously they're looking backwards. They're driving the rearview mirror, and they're still projecting much lower gold prices. I mean, you have to have, in order to see things as cheap the way I do, you have to have a macro view like I have. I mean, perhaps in their minds they're not cheap because they're using an average 6-year gold price, and I think we're going back to 1,500. I mean, so that's what the stocks are pricing in. But the M&A thing it's frustrating to me because I think it's bad in two ways. I mean, one, it's bad for some of the companies that get bought out cheap. I mean, some of the very best companies have gone under the hammer at prices that I owned that were outstanding opportunities, and they sold themselves way too cheap. I mean, Taranga's example number one, right. Rox is example number 2, and Kirkland Lake is example number 3. I mean, the buying shareholders in all 3 of those deals got much better deals than the people who own the high quality, smaller growing asset. So M&A is kind of a sore subject with me. But if I were in this industry and I had, I was a CEO and I had a company with access to capital, yeah, I'd see lots of things to buy.
Yep. Excellent.
And I would also, just before and they're also in a position where this cash flow and the cash position they have, it's a lot less risky of an opportunity to buy. But I mean, I agree. Like, they don't need to layer in any debt to do these transactions. They can do it all with equity or really just cash if they wanted to. So I agree. They're scared to do it. A lot of them.
Yeah, right. Yep.
Yeah, I agree with everything everyone said. So just a couple of thoughts that are a little bit different. Obviously, if you're buying a mid-tier or particularly a junior, you have to pay a premium. You can't do these no premium deals if you're buying a junior. One of the problems, of course, for a larger company looking to acquire a smaller company is that you might be attracted to a particular project, but if you buy the company, you're buying everything the company has, good, bad, and indifferent, and you're paying the same premium for everything the company has. And I think that's one of the reasons that we haven't seen a lot until recently with one particular company, we haven't seen a lot of consolidation in the royalty space because, you know, if companies are trading over book value, you might want one particular asset, but you don't want to pay a premium over, you don't want to pay over book value and a premium over that over book value for everything in the portfolio. And I think that's a problem. You know, I think we all know about, you know, Kirkland and Agnico, and I agree with what Lawrence said, but you know, why they did that and, you know, who they're appealing to. But I think we must be close to the end of these no premium deals, frankly. You know, shareholders, I'm not a shareholder of Kirkland, but if I were, I would be wanting a premium. I was a big shareholder, I am a big shareholder of Fortuna. So we got a great deal with Roxgold. But if I was a Roxgold shareholder, I probably would have wanted a little bit more out of it. So, and lastly, the other thing, you know, I think companies should think more about paying a premium when they're buying something, and let's lower these break fees. I mean, $500 million break fee is, I think, outrageous in my mind. It's basically preventing other people making offers.
I completely agree.
One more point. Yeah, one more point to add as well. If you're, you know, listeners of this call, if you're out there looking for the next potential acquisition target, you know, development stage projects, absolutely, before you initiate any position, make sure to go into the information circular and look at the change of control clauses.
Yeah.
That is one real issue with this industry. There's some real onerous change of control clauses out there, and that could prevent potential logical acquisitions from taking place. So I think that can give you a good sense of the quality of management as well, but also the chance of the desirability of that particular target.
Yep.
Yeah.
Okay, excellent. Let's keep moving on to a couple of questions. Then, in fact, someone mentioned in the comments already that, you know, costs are going up, capex sorry, opex, and there's a cost wave coming. Is that unanimous? Does everyone agree with that? And what are some of the contributing factors for that?
Well, I'll jump in there if I may quickly. Yeah, I mean, clearly, the costs both of building a mine, you know, copper, steel, and the cost of running a mine, primarily energy, as well as, you know, what we call commodity currencies, which accounts for a lot of your local costs. Clearly, they have been going up. But the point I would make is, if you go back to the last time gold was at this level, 2010, 11, 12, you know, oil was at $140, wasn't at 80. The Australian dollar was at a premium. It wasn't a 73 or whatever it is now. So yes, they're going up, but they are still the major cost inputs in running a mine are still considerably lower than they were a decade ago. So the cash flow generation right now should be close to the best it's ever been for the industry.
Any other comments on cost, or we can move on to some other questions that have been submitted? Royalties and streaming companies, bit of a tangent, but do they sit in your portfolios? Are they presenting good value, precious metals royalties companies? What could their place be in your portfolio as well?
Well, I can jump in quickly. I guess in the precious metal space as a whole, I would say probably not, or at the very least, there's significant competition amongst these PM royalty companies, and we've seen it kind of die out. But there was a time there, a year or two back, where, you know, we're seeing a new one of these companies pop up every month, or at least every quarter. So from the royalty and streaming space, I'm actually much more interested in the few names that are focused outside of the precious metal space, and whether it's in the more sexy or exciting energy metals, or in some of the base or bulk commodities. I think from a cash flow multiple perspective, you're seeing pretty extreme disparities between the top tier precious metal names and the top tier names that are focused outside of the precious metal space. So in terms of value, that's actually probably more appealing to me. But I think if you do look at the PM royalty space as a whole, there are absolutely, a few names that you can pick out that present good value. I mean, one of them recently was Golden Valley Mines. That's been a big win within the MJG portfolio. And that's a company that was trading below its liquidation value for 5+ years. It took far longer for that disparity to reconcile than I expected. But we finally had Gold Royalty come in here, and I think Adrian alluded to this earlier on on this panel, and taking out the company at a healthy premium. So I think if you pick your spots, evaluate these companies from a bottom-up perspective, even in the crowded precious metal royalty space, there are opportunities.
Excellent. Okay. I had quite a few questions around jurisdictional risk. Someone's asked specifically around Peru and Chile, if they have administrative changes that might be sort of more left-leaning. Would that be negative for precious metals activity there? It's always a changing landscape, and there's plenty of risks apparent. But how does the panel see jurisdictional risk?
I'll take that. I'm with Rick Rule. There's no safe jurisdiction. I mean, witness in the United States, there was talk in this last bill about putting a 6% royalty on new mines. I mean, that's way above the international average. It's outrageous. Now, it may not make it through, but the United States is supposed to be a safe jurisdiction. In the case of Peru, I hold things in Peru. Hochschild has got most of its production in Peru. It's one of my favorite holdings. It's unbelievably cheap, selling at 2.5 times cash flow. Very well run silver mining company. They've got a socialist or Marxist president, but they've got a Congress that really controls the country. And so I'm actually not too concerned about it. But certainly the drift everywhere, as these businesses become better businesses all around the world, you can assume, and as governments get in more and more, deep doo-doo, which they're getting into all the time with the stupid things they're doing, they're going to go after the money pots. And these things are going to be money pots. So it's one of the problems of the industry for sure. But it's not clear to me. It's ironic, actually. West Africa is actually looking like one of the safer jurisdictions, which never used to be considered the case, because the taxes, they haven't, the countries there have been realistic about the taxes, whereas a lot more developed countries have actually gotten more aggressive about taxes.
Yeah, certainly a lot of great projects there.
Yeah, and I mean the diversification. I mean, obviously we look company specifics and we look at the different jurisdictions, and that is part of the process of what we are investing in. But at the end of the day, I use the portfolio as a diversifier, and the assets are what they are, and the management teams are what they are, and so I focus on that. And then there are going to be some hiccups along the way, but there are also going to be some real wins in some of these jurisdictions. So rather than putting all your eggs in one basket with one company that has an asset, say in Kyrgyzstan or something like that, you can diversify your whole portfolio by investing in a bunch of names, and take the wins for when you can get them, and the losses, you either cut your losses or you double down.
Yeah, let me just jump in there if I may. My own perspective, I certainly agree with Rick Rule and Lawrence that there's no safe jurisdiction anywhere, and we've seen that in Alberta and California and blah blah blah. At the same time, my own sense is that jurisdictional risk is something that you really need to look at very, very carefully, and it changes, of course. And no jurisdiction is perfect, but my own view is we're taking enough risk when we buy a mine or a development project or an exploration project. We're taking a heck of a lot of risk to begin with. And I don't particularly want to compound that by going to a jurisdiction that I know is inherently unstable or risky.
Yeah.
I thought this would be a bit more of a loaded topic here. I guess we don't have Maren Katusa or Thomas Kaplan on the call here, sticking solely to the first world jurisdictions. I will say I agree with the rest of the panelists here. I am more tolerant towards jurisdictional risk than most investors out there. In the MJG portfolio, we have exposure to countries like Ecuador, Argentina, Bosnia, Ivory Coast, Mali. These are some of the names that come to mind. I'm much more focused, and this is harder to evaluate, but I'd say far more important is local support for a given project. On a national level, politicians come and go. based on the election cycles. But if you're looking at a specific asset, if you don't have the local community on board, they're going to be there for the foreseeable future. And so that to me is a much bigger deal breaker than whether I'm investing in a specific third world jurisdiction or not. That said, I do think you have to balance your risk. And I think Peter made this point well. You know, if we are, you know, we do have exposure to Ecuador and Bosnia, as we said, but I try to keep that to one position. So, you know, you got to make sure that you're not too overweighted to any of these jurisdictions. But on a case by case basis, if the management team checks out, the project checks out, company structure checks out, valuation checks out, upcoming catalysts look good to drive value, then I am willing to plug my nose for some of these jurisdictions.
Certainly. Okay, excellent. Local support you touched on there, Matt, for sort of being essential. Are the companies doing more, do you find now, to sort of win over or sort of work with communities? Are they better prepared and better in their approach and their messaging, if you like, on the S within the ESG criteria at the moment?
Let's say at the moment, I mean, most everybody is at least paying lip service to the ESG angle, but I think you have to differentiate the pretenders from those that are actually doing it well. And I mean, one of the most obvious things you can look at is whether, you know, said management team has actually built and permitted a mine in the country where they're trying to do it again. Additionally, are they hiring local? You know, are the executives of said company, you know, based up in Vancouver and Toronto and a bunch of white guys, or in some of these jurisdictions, have you hired local for some of the senior levels of management? Obviously, there's so many other different variables on the local level to evaluate. You know, I find going to site can be one of the better ways, and it's you know, it's difficult, especially in this COVID era, to visit each and every one of the projects that we have exposure to in the MJG portfolio. You can get a real sense for the lay of the land, you know, the proximity of local communities, you know, whether they are hiring local or whether it's a bunch of Canadian consultants that are showing you around the site. So you can kind of peel back the layers of the onion better if you're there in person.
Yeah.
And also, Matt, the reaction that the visiting CEO and board gets when they go on site, do the local people come out and hug them and welcome them, or is there a sort of suspicion and a somber? You know, I've been on sites where, you know, the directors and the analysts all came down, and you know, it was like absolute dead silence. Nobody wanted to talk to these people. Well, that's a bad sign. They should come out and welcome the people that are spending the money.
That's right.
Absolutely.
You don't want to see any flak jackets or AK-47s either. That's a red flag.
Peter, how do you sort of look at ESG across your portfolio? So it's sort of a changing landscape in terms of what you need from companies, and then also what you might expect, you know, get from them.
Yeah, no, I mean, I spent you know, almost 10 years at Franklin Templeton, traveling, looking at sites, and that was part of the major part of the due diligence was getting a sense for what the people on the ground were saying. Because, you know, the CEOs, the CFOs, the IR guys can come around and tell you their spiel, but it's the spiel that they tell everybody. And once you get interacting with the operating guys and the local community, you get a better sense for things. So, you know, I always say that on the ESG front, it's becoming very important. I get it. But the mining companies, a lot of them, most of them, had to be in front of ESG well before this became a pertinent topic, because they wouldn't be getting these mines built or getting the access to the to projects if they hadn't developed these relationships. And so, you know, it goes back to developing relationships with management teams and trusting people that you've worked with over the years and knowing that they're going to do it the correct way. So I think that a lot of these companies, you know, there are companies that are bad apples and they've had problems, and I hopefully try and avoid those companies. But a lot of them, a lot of these companies are doing a good job, and they're trying to, you know, incorporate interaction with the companies, First Nations, you know, a lot of these groups that are very important in getting a project through local government, but also to succeed as they're producing. So, and then in the rest of ESG, I mean, I think there is obviously room to improve in terms of board composition and corporate culture and how they're dealing with compensation. And I think it's a work in progress that people are doing a lot of work on. And I find that some of the smaller, earlier stage companies that I'm dealing with, I spend a lot of time talking with the management team and the board and helping them, put things together the way that makes sense, within reason. Again, I don't think we can, I definitely think that the world is moving a little bit too far to the left in terms of how they're doing things. But, there's within reason, there's ways that people can improve.
Yeah, Tony. Well, that sort of leads to my next question around capital flows into the sector. People looking, new capital or generalists looking to get back into or indeed explore for the first time gold mining equities, precious metals mining equities. Is the ESG element slowing that down somewhat? Is the crypto element slowing that down as well? We've had a few questions come in that way. People are sort of like weighing up where they can stick their money now. They've got different asset classes. Can we get some commentary on that at all?
Well, I'll jump in if I may. I think crypto, from my experience, crypto is very much at the margin. I don't see a lot of evidence for people who would have bought gold have bought crypto instead. I think it's a few highly publicized cases and very much at the margin. ESG, I won't go on my ESG spiel, but in regard to your question, is it stopping people coming into the sector?
Yeah.
Look, you're driving around with a Tesla and you're wanting windmills and clean energy. You're going to have mining, and it's hypocritical and ignorance to think that you can avoid copper and nickel and steel, but still have windmills and Teslas. It's just ignorance and hypocritical.
Or even your cell phone, even their cell phone that you're pounding away.
The whole thing, everything. Yeah. And, mining by nature, it disrupts the environment. Now, we don't want to put arsenic in the local water supply, but it disrupts the environment. And to pretend otherwise is putting your head in the sand, I think.
Yeah, very straight up, very true. I've had a question, more technical question come in, is existing infrastructure an advantage for your investment in an exploration project? How would you look at existing infrastructure sort of as a positive? I guess there's so many other factors involved, but someone specifically asked for that.
Yeah, the way I would interpret that is, the way I interpret that is that the easiest way to find gold or precious metals or any commodity is somewhere where it's already been produced. And
right.
So if there's an existing infrastructure, it doesn't mean it's going to help you with how you're going to produce it. You may take a different approach. It may be an open pit rather than underground. But at the end of the day, if you know that it's there, it has been in the past, it doesn't hurt to have that infrastructure. But obviously in terms of roads and power, that can obviously help and make a fast tracking a project much easier.
Yep. Do you like brownfield sort of projects then? Do you hold many of those within?
I have some. It just depends on the assets. I don't say I have a favored kind of way of looking at things. It just depends on the team and what they're looking at.
Yep. Larry, you were gonna jump in.
Yeah, there are definitely some companies that do have that, and it's a big advantage. I mean, a couple that I own are somewhat in that box. Troilus is one of them, and Maritime is another one. Guanajuato Silver just bought a mill for pennies on the dollar. Bought a company that sold for $200 million, a bunch of years ago for $15 million, and got all the assets, all the underground deposits, and the mill, which only need a little refurbishing. So yeah, I mean, you can buy. The thing that's interesting about this industry is if you study it and you get to know the assets really well, there are just unbelievable opportunities out there. I mean, and in turn, there are other things that are just incredibly overvalued, make no sense whatsoever. So it's the reason why, good stock pickers can really generate alpha in this space.
Mm-hmm.
Just to add on, I mean, I think existing infrastructure is a very important variable, but it's one of many variables. And you just have to understand as an investor, if you don't have the infrastructure advantage, the bar is that much higher to discover an economic deposit, both from a grade and tonnage perspective. But as we've seen, there are groups that have gone out and made phenomenal discoveries, you know, whether it's in the Golden Triangle or out in the middle of the Congo. It's just, you have to find something that's that much more special. I guess from a brownfield perspective, infrastructure is part of it, but I do favor brownfield deposits, and it's more for the permitting perspective. There's already been disturbance in that case, and local communities in some of these cases have seen mining activity in the relatively recent past, and would maybe be more in favor of seeing that started up from a job perspective. So brownfield's interesting to me from an infrastructure perspective, but also from that permitting angle as well.
Okay, great. Silver and also platinum within that, as we're talking precious metals more broadly. Do you gentlemen like silver equities miners, and do you hold any? And if so, how does that sit or work within your portfolio?
I'll take that one. I own a lot of silver, probably 30 or 40% silver miners versus gold miners. I mean, so silver is just a higher beta gold, right? I mean, it's it moves harder, it moves faster. It's got two uses. There's not as much stockpile out there, which is part of the reason why the price moves so quickly. And there's a big, stock to flow in gold, and there's much less so in silver. But in turn, when it goes against it, silver gets hit a lot harder. But I love silver, and silver is getting used in a lot of these ESG things. And we haven't talked about all the solar panels and the Teslas and all the things that are being done in the ESG world all require silver. It's the best conductor out there. So I'm a huge silver bull and have a lot of my investments in silver. Yeah,
there's not that many silver producers out there, though. So do you look at the new explorers coming online, or do you sort of hold the top tier and the price to do this thing?
All of the above. I mean, you're right. It's hard to find pure silver plays. I mean, obviously, you buy wheat and precious metals. It's still got almost a majority of its revenue out of the silver side. Mm-hmm. But there are enough producers, and there's some big ones. We pick away at those, and there are developers and producers. There's a lot coming out of Mexico. I mean, there are a lot of companies that I've got that I really like. Minera Alamos is a Mexican developer that I really like a lot. Silver.
Excellent. Matt, is it silver for you, or do you got nickel in the portfolio? You have other metals as well, but you're primarily in gold. Is that right?
Well, we're about 30% exposed to gold and close to 10% silver. Maybe 8 or 9%. Yeah, but at the risk of sounding like a broken record, I think it's very important not to get intoxicated by the focus metal. Focus much more on the people, much more on the asset quality at spot prices, all that good stuff from a bottom up perspective. That said, one thing in silver's favor is if you go back 50 years to the beginning of the 1970s, we've never seen the gold price make an all-time high without silver following in the next 2.5 or 3 years. Sometimes it happens alongside gold. Sometimes there's a little bit of a lag there. And again, this isn't an immutable law of nature. This time could be different. But if recent history does repeat itself, that would signify that 3 years from August 2020, so we'll say August 2023, if history repeats itself, we would be talking $50 silver. And that's a very significant move. I think that's 120, 125% move from current levels. And that's just the metal itself. So the leverage that you could get from well-picked equities would be many multiples of that. So silver is definitely interesting. And we're not in this kind of Reddit-fueled silver environment like we saw a year ago. The sentiment's kind of cooled down. So it's an interesting time to be looking at the metal, I think.
Yeah, certainly. Okay, excellent. Well, look, we've covered a great deal. We've lost Adrian again, but I think we're going to leave it there because we've covered the majority of the good relevant questions. So I'll say thank you very much to my panelists. I know we have a hard stop and everyone's going to get back to other duties. So thanks for your time this morning, and I hope you have a great rest of the day. And to the viewers, there will be an available replay of this if you did tune in a bit late to catch those insights. So thank you everyone for tuning into our webinar. Cheers, guys.
Appreciate it.
Thanks, guys.
It's been fun, gentlemen.
Have a good one.
Thanks.